As long-term investors, we want our stocks to go up over time, but sometimes the stock price of a company grows far more quickly than the growth of the underlying company, and at that point in time, the stock price might be overvalued in the marketplace. So, what should we do as investors when a stock is overvalued? Should we sell it? Should we keep buying? Maybe we should wait for it to fall and hopefully buy it at a cheaper price. There's really no singular right answer because personal finance is personal and everyone has to make their own decision based on their situation. But in this video, I'll be sharing some strategies and frameworks that I use and think about in my personal investment portfolio. So, first of all, it's important to verify that this company in question is a high quality company that you want to own for the long term. Periodically, we do make mistakes as investors. So, if you do own a company that you're not super happy with or you don't see it being a fantastic performer in the long term, then selling it might not be the worst move if the stock looks to be drastically overpriced based on your analysis. In some sense, this is kind of the best case scenario because the decision, at least to me, seems to be a little bit easier. The only caveat here is that if you do sell, you should be thinking about what you're going to do with that cash that you generate. I think it's good generally to have some cash sitting around ready for opportunities. But if you have huge sums of cash on hand, then you're likely losing out on the opportunity cost of being invested in the market. But the bottom line in this situation, though, is if you're not thrilled about the long term prospects or quality of the business and you think it's drastically overvalued, then selling could be a pretty good option. Now that we got that out of the way, future ideas that we'll discuss will assume that the company you own is a high quality business that you want to own for the long term. So, again, let's consider just selling. Even though we just talked about that, I think it's a little bit of a different situation since you want to own the company for the long term. So, if you do sell the stock, you won't be invested in the company anymore, which we just said above, you want to be invested for the long term. So, you might not want to sell. You might say, well, I think it's way overvalued right now, so I'll just sell out and wait for the stock to drop back down to a more reasonable price, and then I'll buy back in at that point. And that's a reasonable strategy, except that you really have no idea what will happen in the stock market. So it might take years for that stock to, get back to a price that you think is low enough, and maybe it's possible that the stock price never gets that low in your lifetime. And it's also possible that the stock price could just keep on climbing and you'll be left on the sideline with significantly less gains than you could have had if you just held the stock and rode that ride, with the stock itself. So I wouldn't say selling in this situation is a terrible approach. It's definitely, a personal decision, but I think it's probably not what I would choose to do most of the time. In the vast majority of cases, I probably wouldn't sell a stock that I want to own for the long term, just because it seems overvalued. Now, the next two strategies that we're going to discuss are going to involve options, and I'm sure there's plenty of more complicated option strategies out there that you could use in this kind of situation. But I'm just going to stick to two fairly basic strategies. And the first one is selling a covered call. So in order to do this, you do need to own 100 shares of the stock in question. And then what you're basically saying when you sell a call is that you get to choose a strike price and an expiration date. And essentially, if the stock price is above the strike price on that date, then you have to sell your shares at that strike price. And for agreeing to that contract, you receive some amount of premium that you just get to keep into your account. So let's take a look at an example to see how this might work. One of the stocks I have analyzed on the channel in the past is Williams Sonoma, ticker symbol WSM. And when I analyzed the stock, it was trading at around $120 per share, and I thought that was about the fair value. But since then, the stock has climbed over 50% in just a few months, and it's now trading in the high 190s. I wouldn't say this is, insanely overvalued, but it seems overvalued to me, and some other investors that I talked to recently agreed. So let's say, just for this example, that we own 100 shares of Williams Sonoma, and currently our average cost is somewhere below 190 per se, and we don't think that Williams Sonoma will reach $230 per share by February 16th of 2024, which is a little bit more than 2 months away. So we could sell the $230 call at the February 16th expiration date, and for that we would receive about $160 in premium. And these are all real numbers, by the way, that I'm pulling off the option chains that are available, on any typical brokerage. And now on February 16th, if Williams Sonoma stock is below $230 per share, then we get to keep all that $160 and we get to keep our shares of the stock. But if the stock is above $230, then we again get to keep all that $160 premium that we collected, but we have to sell our shares at $230 per share, even if the stock is trading, at a higher level than 230. And if we think the stock is overvalued now, then it would be even more overvalued at $230 per share, and really wouldn't be the worst thing in the world if we had to sell our shares at that price. But the ideal situation with this strategy is that the stock stays below $230 per share, and we get to keep that premium and reinvest it back into the portfolio at some point in time. So I think this strategy is really best for those who have relatively large portfolios, because you have to have 100 shares of the stock to sell a covered call. And you have to really want to own the stock for the long term, I think, as well. But you also don't want to be, absolutely 100% against selling, because sometimes you might have to sell. There's some ways to get around it. You can roll the call out further in time and do some more complicated things there. But generally speaking, if you're going to sell a covered call, you want to be at least open to the idea that you might have to sell your shares at that strike price. But the good thing here is that you can choose the strike price, so you really get to choose what price you have to sell your shares at, if it gets to that point. So the next option strategy is a little bit similar to selling a call, but it does have some important differences. First of all, what we'll be talking about here is buying a put option. Now, this can be better for investors with smaller accounts because you don't have to own 100 shares of stock to buy that put like you had to do with the covered call. But it is, in my opinion, significantly riskier, which we'll talk about as we go. And I've never really bought a put at all, so I don't really have as much experience with that, but I have sold cover calls before. So the idea here is that you buy a put now, and then if the stock is overvalued and the stock price goes down at some point in the future, then you can sell that put for a profit, because a put will become more valuable as the price of the stock goes down. The part that makes this strategy a little bit more risky is that for the most part, the stock has to go down in order for you to make a profit. Whereas in the case of the covered call, the stock usually can still go up a fair amount and you still make a profit and oftentimes still remain in the ideal situation. So like we saw in our covered call example, the stock right now is around $197 per share, and it could go up, 15% about to $229 per share, and you're still in the ideal situation, which is that you keep all that premium and you don't have to sell your shares. So you basically make some money there. But with a put, the stock pretty much has to go down for you to make money. It can't go up a little bit. That's probably not going to work. Let's take a look now at an example again for Williams Sonoma, where we buy a put. This is often called a protective put. And typically when you buy an option rather than selling it, it can be better to go further out in time. But for the sake of comparing it directly to the covered call strategy, we're going to choose the same February 16th expiration date, and we'll choose the $170 strike because that has a similar delta to the $230 call. So it has kind of a similar probability of being in the money at expiration. So if we did buy the $170 put at the February 16th expiration, we would have to pay about $210 to buy that put. And when you buy an option, you usually want to sell it a few weeks before it expires. So let's say we plan to sell it around February 1st, which is about 2 weeks before expiration. So we'll sell it, that time. And if the stock price at that time is around $170, then you'll probably be able to sell the put, based on looking at some data on the options chain, for about $410, which would be a profit of $200. And we can't really get an exact price there because we don't know at what price the put will be trading in the future. It's a little bit less known when you're buying options. So in that case, if the stock price is $170, you'd profit about $200 on that put. Now, if the stock price is even lower, you would profit even more, which is great. But if the stock price is still around $197, so if it didn't really move at all, you'd probably only be able to sell the put for about $50, and that's a pretty substantial loss on your investment into that put of $210. So as you can see, this strategy is a little bit more risky. It's a little bit less of a win-win situation like the covered call is. But if you do have confidence that the stock will fall, then it definitely could work out. And you certainly can go further out in time with that expiration date, like I said, which can, generally speaking, lower the risk. Now, the last scenario I do want to discuss is just to basically do nothing when the stock is overvalued, which is generally what I do most of the time. I try to be fairly conscious of valuation when I invest, so I'm not going to be too inclined to buy more of the stock if it's significantly overvalued. And like I said, if it's a company that I want to own for the long term, then I won't really be inclined to sell it either. Not only if you sell, will you miss out on future price appreciation that may happen, or be stuck waiting a long time for the price to drop, you could miss out on lots of dividend payments that you could reinvest back into the portfolio if the company does pay dividends. I will definitely, I think, consider selling covered calls on some stocks in my portfolio at some point in time in the future. But for right now, my dividend portfolio is much too small for that. And when I get to that stage, I definitely want to be very strategic and only sell calls on stocks that I think are very, very overvalued and choose strike prices that I don't think are going to expire in the money. Now, the one thing we haven't considered yet is taxes. And if you're in a tax advantage account such as a Roth IRA, then this doesn't really matter to you. But if your investments are in a regular taxable brokerage account, then you should be aware of the tax implications of pretty much anything you do with your investments. So if you sell your stock, then you will have to pay capital gains taxes if it is for a profit. And that could be at the long term or short term rates, depending on when you bought the stock and maybe some other factors. And also, any option profits that you have are taxed at the short term capital gains rate. I generally see taxes as a sign that you're making money, so I try not to worry too much about them, but it's definitely something you need to be aware of and fully consider the implications of when making investment decisions. So, like I said, the strategy I like best in most situations is just to sit around and do nothing. And while you're waiting, you can always research other companies and look for other opportunities that may be in the market. As the recently deceased Charlie Munger said, the big money is not in the buying and the selling, but in the waiting. And I think this fits well with my general view that you should usually try to choose a simpler approach to problems when possible, unless there's a pretty good reason not to. Because generally speaking, I think less can go wrong with the simple approach. And I think that's the case here. Sitting and waiting is definitely the simplest approach, and I think it's a winning one when you pick winning stocks. But if you do have a differing opinion, definitely let me know in the comments below. I'm always looking for new perspectives and ideas about investing, or you're more than welcome to join my free Discord server and share your thoughts there with even more people and see what they think. The link for that will be in the description. Thank you for sticking around to the end of the video. I really do appreciate it, and I will see you all in the next one.